How do you value an asset like XRP that's designed to move all the money very quickly and efficiently? This is a great question, and I'm part of a team that has been attempting to answer this question via building a series of quantitative data models. And I'm here today to share the results and sort of the strategy for the first model, which we're calling the collateralization model. Hey, welcome to the show. I'm Molly. Today we're going to talk about the first model that is ready to be released from Jimmy Valley's XRP Buyback Confidential Committee. Lots of words in there. Within this confidential committee that has about 50 or so people, we have a group of about 6 of us that have been tackling this idea of quantifying, valuing this asset. And this has not been done before, as far as we know. Maybe Ripple's done it, or people who work in investment banks, but nothing that we have found has been shared in the public realm regarding how to quantify the value of this asset once it's allowed to run free and do its thing. So our strategy has been to come up with multiple approaches. I think we're going to have about 5, possibly 6 different models that tackle this valuation project from a couple of different directions. Some are very theoretical math, some are more econometric financial modeling, and then some are more like accounting type, cost basis type things. I'm going to be doing a separate video on each of them. Today is the first one, called Collateralization, and it's remarkably simple compared to some of the other ones. So it's a perfect one to start with. I created a graphic to go along with this because I'm a visual person and I think it's easier to understand something like a financial model if it's broken down in kind of simple, easy to understand concepts, some of which are displayed here. So I'm just going to run you through this model and what we're attempting to capture and quantify. So this idea here is that this is a fair market valuation. We are not looking at the market value. I'll put my video in the description to explain the differences. This is more of an academic exercise, theoretical, where we are taking a bunch of inputs and assumptions, creating a formula essentially, and the end result is basically a number. Very, very different than what is traded on exchanges, which is not this at all. And our assumption here with this first model is that we're going to leverage this idea that the Fed has announced publicly, and they refer to it as their Big Bang single day migration to tokenized monetary system. The idea is that all of the sort of financial markets would migrate to a new system in one day, which makes logical sense. I've talked about this too in my videos about tokenizing the stock market, is you can't sort of have 2 things running at once. It would be a little bit disruptive and create lots of arbitrage opportunities. So many of these markets will be best served if you wake up one day and it's sort of moved to this new system. So that's the assumption here, that we're not doing a staggered approach to this new world. It's that what would happen hypothetically if we woke up and all of the money in the world was migrated to the blockchain. We're also making the assumption that all the money will be moved on the XRP ledger. That's part of this academic exercise, is to figure out what would be the value of XRP if this scenario happened, which we at the people on the committee are partly on it because we have high confidence that XRP and the XRP ledger will be widely adopted in the financial system. Now, the first part of this exercise is to quantify what we call all the money. Neat concept. Spent quite a bit of time in that little rabbit hole, because when you think about that at face value, sometimes it's like, well, all the money must be just like all the dollars that have been printed and all of the cash. Well, money is essentially value, and there's many, many sources of value. And we live in a world where money is actually debt. So all of the loans and bonds and stocks, they're all money. So we have generally a couple different classifications. We have the actual money that's been printed. We have stocks, bonds. Then we have real estate, which again is a form of value. Like if I own land and I needed to buy something, I could liquidate that asset and exchange it for some other type of value. There are also assets that central banks hold. There is the entire derivatives market, which is the largest, actually valued at $600 trillion. We also have the United States federal deficit. Then we have assets like gold, silver, energy, commodities that are also representations of value. So, what we ended up doing was totaling up all the money and arriving at an estimate of $5.3 quadrillion for the current today's 2023's value of all the money. Now, the thing that's challenging for this is that there are many sources of value or money that are a little more nebulous and harder to pinpoint. One of which is a fascinating topic, which is the North American Water and Power Alliance. I will likely do a separate video on this. This is a fascinating project that was started in the 60s and 70s designed to help with water stuff like moving rivers and streams to remove flooding in some areas and mitigate drought problems in other areas, dam building and that kind of thing. There's also now this project was tabled back in the 70s according to Wikipedia, but in 2011 a lien was filed that we have the official paperwork on for $14.3 quadrillion. The fascinating thing about this paperwork, and I'll get into this more deeply in the separate video, is that this loan was taken out using the citizens of the United States and all land in the United States as collateral. So I did not personally agree to be collateral for this loan, so I'm a little bit annoyed about it, but we will save that topic for another day. Another thing that came up recently was the Bank of International Settlements publicly shared that there is a massive amount, $80 trillion in off-balance FX swaps. We'll probably do a separate video on that too. But as the exchange rates in the world are variable, some countries get nervous that if they're used to participating in trade that requires them to exchange into dollars, what if that exchange rate gets so out of whack that they end up losing a lot of money? They can create these sort of like side deals in the derivatives market to hedge against that. And as the dollar has gone up so much in the last couple of years, and other currencies consequently go down because all currency valuations are relative to each other, what has happened is you have this massive market now for these foreign exchange swaps, 80 trillion. So that's also considered money. That's part of the value that gets moved around the world. And it's difficult to take it into account because a lot of these derivative products kind of happen in the shadow banking world where they don't have to report these numbers, where it's a little bit more uncertain or unclear, the exact amounts, the terms of it. So one of the challenges we have with this model is coming up with this definitive number of what is all the money. And there's also things within the US government, the Department of Defense. Recently, they're announced trillions of dollars are missing. Where did they go? There's lots of chatter for decades about, a secret military budget, black budget, you could call it, the secret space program, all these things that cost tons of money. Well, forget about whether or not those things are good for us to have. If money is being allocated to them, we need to account for that. And that's difficult to do because these are often very covert or clandestine type programs. Then there are the unfunded liabilities within the United States government, like Social Security, Medicare type things, where there's fraud. We don't always know the exact amount. So there's a bunch of stuff that is also part of the value in all the world's money that we haven't necessarily accounted for. So our approach with this was actually to be conservative and only include value estimates that we could kind of document through mainstream media sources, but know that there's a huge amount of value that exists that we're not counting for. Therefore, our conclusion is might be a little bit shocked when you get to the end, but the conclusion is that the number is we came up with is probably very low relative to what it should be if we were able to fully document all the money in the world. Another assumption that we made, and this is sort of the key idea, is that there's 100 billion XRP that have been minted. Some have been burned. Some are maybe missing and lost wallets or not. But we're going to base our model analysis on the circulating supply. Because if the XRP as a utility asset is not able to be used, it's not part of this flow of money. So we have made the assumption. So all models have assumptions, and that's actually like a sort of mathematical type term in this case. And when you list out your assumptions, you can debate them, and we'll have actually a open forum for anyone that would like to participate in debating the various assumptions of the models to do so. But I'm just going to share with you at this point what assumptions we have made to be able to complete this. So we are basically working with about 50% of the totally minted XRP being part of the circulating supply. And this approach is different than some of the other models that are looking at adoption rates and network effects and growth rates. This is what's called a snapshot of the balance sheet, like a moment in time approach. We have said, okay, as of today, January 2023, this is our estimate of all the money in the world that we can document with confidence. And that is going to be what our number is that we're starting with. Another thing that's key, I think, to understanding this is to use an analogy with casinos. So if I were to go to a casino with all of the money that I have, I'm not saying this is a good decision or anything I'm planning to do. It's hypothetical. So I go to let's say I have $10 million and I go to the casino with my $10 million and I want to have the option to gamble as much of my money at any point, at any table, in any private room or whatever. And this casino is pretty cool. It runs 24 hours. And I want to take all of my money and potentially gamble with it at my leisure. Now, the casino, what I need from them is I need a poker chip for every single dollar in the 10 million. Now, that doesn't mean that I'm going to trade or gamble with every poker chip at each time, but I need to have, in this model framework, I want to have the option to gamble with all the money at any time without constraint. So what's going to end up happening is the casino is going to give me a poker chip for each dollar. There might be different denominations in this example, but the idea is that I'm getting a mirror representation of my offline money in casino money. If you're familiar with the idea of wrapped tokens, this is kind of similar. So if I had a blockchain that was not interoperable with another one, and I had a bunch of Bitcoin, for example, and I wanted to move that value on the Ethereum blockchain, I would take all my Bitcoin, and what would happen is they would get held in a little escrow thing, and then somebody on the Ethereum blockchain would mint me a bunch of mirror tokens of those Bitcoins that I can use on the XRP or the Ethereum ledger blockchain, whatever. And the idea now is that you have two families of assets. You have the original asset, my Bitcoin in this example. Then you have the wrapped Bitcoin that exists on the Ethereum blockchain. They are the same amount of value, and you can't use both at the same time. But let's say in this example, the Bitcoin, I'm just making this up, but let's say the Bitcoin blockchain was going to be unavailable to use after a certain point. So all of the value that you had on that blockchain needs to now get moved to the Ethereum blockchain. So you're going to issue me these wrapped tokens. And if this Bitcoin blockchain is going away, I need to move all of my Bitcoin. I need to get wrapped assets for 100% of it. That's what this exercise is we're saying that the world is moving to a tokenized world, and all the money is going to be tokenized. In a world where everything is tokenized, every asset that you could exchange or sell will eventually be tokenized. And that gets a little crazy when you think about, well, I sell my time and I have my ideas, and how am I going to? So for now, we're just going to stick with what we traditionally call assets that are easy to value and easy to liquidate. And this is why this model is actually called collateralization, because we're generally referring to things that are often used as collateral in loans. Gold, stocks, cash, diamonds, silver, oil. And that's what we are using for this. So back to my casino example, if we want to create a representation of all the money on the blockchain with this assumption that the world is moving to this new thing. So you can't keep the way that money is valued. Like, you got to get rid of the old money system. That doesn't mean those assets don't exist. So like if I have a bunch of gold and I could trade that gold, and we're now going to be doing all the trading on the blockchain, the value of all of my gold has to be represented on the ledger. There has to be a token for everything of value that somebody would potentially want to buy and sell. Now, that doesn't mean that all of these things will be bought and sold on a daily basis. It doesn't matter. It means, like, if I'm taking my 10 million to the casino, I'm not just going to ask for only the poker chips that I want to trade that day, or say, well, I'm going to trade some of them for poker chips because I might win. And then if I win, I'll take those same poker chips and play roulette. That you could do that. But the exercise here is we're taking the 10 million and we're going to simulate what it would be like if all of the money was moved to the blockchain, which is why this particular model doesn't take into account some of the variables that other models do, where the same XRP could be used for multiple transactions in one day, because this is more about collateralizing all the money in the world onto the ledger in one step, in one day, in one big bang single migration. Now, the way I actually didn't build this model, but the way this model was built was this assumption of all of the money starting out with 5.3 quadrillion. And then we adjusted it because part of this exercise is we want to, this isn't happening today, right? So we're looking forward to 2030. That's sort of this end goal. These simulations are, what will the value of this thing be if everything's allowed to run free? We have no more lawsuit or restrictions, and all the SEC government things get out of the way. And we now get to this point where there's 100% adoption, the thing's doing what it's supposed to do. What would this look like? And so we have this thing called a risk adjusted ratio. And that just basically bumps this number up, knowing that that money would be worth more in the future. But then we have to also bring that back down using what's called a present value 10. This kind of accounting terms. We're going to have a paper that is going to show you all of these formulas in greater depth. This video is just an introduction to the concept to let you know that we have been doing some traditional kind of investment bank / accounting techniques to help kind of factor in the variables of time and bringing things down back to the present value. As I mentioned before, one of the other key assumptions is that we're not basing this on all the XRP that's available, because the circulating supply is really what we would have to use. If a bunch of XRP are burned or in a lost wallet, we're not going to be able to move all the money via those tokens. Like, they don't exist. Starting at the 5.3 quadrillion, we bumped that up with the adjustment rate, ended up at 6.6 quadrillion, applied a PV10 total value. And when we divide that by the 50.7 circulating supply, which are the tokens that are available, we have a value of 122,580. That means that XRP needs to be valued at that level in order to be able to cover all the money moving to the network. Again, I'm going to this casino window with my $10 million. I need to have poker chips. The casino, they don't have 10 million poker chips. Let's say they only have like 5,000 poker chips. They weren't expecting me to show up with my $10 million. That doesn't matter. The number of poker chips doesn't matter in this example. What matters is the $10 million value. So what they would do is they would say, all right, you have $10 million. We're going to divide that by the number of poker chips that we have. And therefore, for you, each poker chip is worth whatever that math is that I'm not going to be doing in my head right now. And the idea now is that all the value is represented, but it's broken up into smaller denominations. So when I go to play a game at the casino, I don't have to bet all $10 million in one with one chip because I now have a whole bunch of chips. The same idea applies here. Now, this model, I think, makes a lot of intuitive sense to me. There are some drawbacks to it. Namely, it doesn't really account for the fact that over time, as XRP becomes more adopted, there will be a competing force from the store of value. If you watch my video about the virtuous cycle, then I went over how these sort of cyclone of competing forces between adoption and utility and desire to store value end up competing with each other, and they push the value up a lot. It's a neat idea, and it's a little bit challenging to like mathematically model, and we are incorporating that in some of the other ones to the best of our ability. But this particular model is more a snapshot in time and does not take into account any of those factors. The other problem here, as I kind of mentioned to you a few minutes ago, was we're not able to account for all the value because it's not all documented. There are covert programs around the world that have a tremendous amount of money. There are wealth sources that governments and very wealthy people have that are undisclosed. So we are only able to account for the value that we're aware of and can document, which means, even just this one 14.3 quadrillion lien, our total here is 5.3 quadrillion. If we were to include this lien, it would go up from 5 to like 20. That's a big difference. So the number would probably go up at least 4 times. So that is one of the reasons this approach is actually fairly conservative, is that we are not including value that we're not able to clearly document. And then there is this idea that the value of XRP is based on transaction and usage, and that because the same XRP could be used multiple times, many times in a day, that should be accounted for. And I think that's a neat topic, and one of the models specifically does address that. That's not here. This is more the snapshot in time. But the general idea here, which I think makes a lot of sense, is that we are moving to this tokenized world. If the old world system, not the stuff, but like the medium of exchange, if that goes away, it's almost like everybody's exchanging information by fax machine and we're moving to email. And I'm telling you, like, there's going to be a day where you cannot fax anymore. Like, the fax network's going down. You have to move to email. So we're going to have to take everything that's being done, the value of that fax network, and move it to the email network, knowing that one day we're going to wake up and you're going to get the call, hey, no more faxing, everything's email. All of the world's value needs to be prepared to move to this tokenized world. And our assumption here is it's going to be represented on the XRP ledger. It's going to be transacted using digital assets. And that is the collateralization model. All right. So I don't know when you're watching this. If you're watching this in a while from when I'm recording it, some of these other models will already be available, and I will link them all in a playlist. If you are watching this shortly after I've recorded it, you're going to have to be a little patient. We're going to be releasing probably 1 to 2 of these a week for the next couple of weeks. So it's now kind of later-ish January. I would expect by early February, all of the models will be released. We're planning to also have a formal paper that summarizes all of them together. It is not our position at this point that we are going to have like this one is best. What I am going to probably look to is to find what do all of these models have in common. And if I had to rank them, I would probably pick the middle median value for this exercise. We'll also talk a little bit more about what if you're an XRP holder, like what can you do with this information? There's a lot of things. I know this originally came up in the context of approaching the Fed to buy back the asset. That is one approach. Now that was like over a year or 2 years ago, almost a year and a half ago. A lot has changed since then. We have learned about a tremendous amount of corruption in the government, and it's become very clear that there was a concerted effort to suppress the price of XRP. Well, if we now know what the fair market value is, and we've built 5 models, and we've sort of taken the average of them, you now have some data that you might need to use hypothetically in a situation that you might choose to embark in. There's also some other neat ways that we as citizens and civilians could create our own marketplace around this value that we now know is worth a lot more than what might be exchanged on the marketplace. So anyway, if you like this video, please hit the like button, subscribe so that you can get some updates on future ones. I do welcome any comments. One thing that I would like to just leave as last parting words is the other people participating in this and myself, we are very excited to get your feedback on the models themselves. We would love a very healthy debate on the assumptions. Maybe there's a number you would do differently, or like a step that we forgot. Constructive debate about this is absolutely welcome. If you're just going to say the whole thing's stupid and you think that this is hopium, then I'm going to ignore you because that's not really helping any of this move forward. So please share in the comments. We'll probably have some amazing discussions going on Twitter, and then we'll probably figure out there's some other ways that we can continue to have everybody debate the merits of the different models to help determine, which one do we think is most likely and most viable. And it'll honestly probably be a combination of several. That is what the real world reality is. All right, I'll see you in the next video.